What's up, everybody? Welcome back to the Stocktrades YouTube channel. My name is Dan Kent, one of the co-founders of Stocktrades.ca, one of Canada's largest investment websites. So this week, we're going to do something a little bit different, and this is actually due to a crazy amount of demand from people emailing me, people commenting on the videos, people commenting on the website. They want to figure out how, especially during this crazy time in the world with the geopolitical tensions, the war, inflation, supply chain issues, everything that is going on right now, the markets are taking an absolute beating, and they want to figure out how they can hedge or, gain exposure to some of these rising commodities. So I decided to dig in last week, do a bunch of research on a bunch of commodity ETFs. This video is going to go over a ton of popular commodities. We're going to go over oil. We're going to go over agricultural options, wheat, corn, uranium, gold, silver. So for the better part of this video, I'm just going to turn the camera onto my screen and I'm going to walk you through all of these ETFs, who they're for, who they're not for, what they exactly get you exposure to, and how they can help you in the current environment. So let's go. So a few things before we get started. Head down below, like the video, subscribe to the channel, and make sure you comment. If you do comment on a video, you are eligible to win a Stocktrades premium subscription, which is a $300 a year platform we offer. You can join over 1,800 other Canadians. And one more thing, we have opened up a smaller section of the Discord to the public. So I will put a link in the description to the Discord. You can hop in there, chat with both Matt and I and many other people inside. But all that said, let's get started with our first commodity ETF, which I'm going to tackle oil first because it seems like this is the most glaringly obvious one with people being hit very hard at the pumps. And I'm going to go over a oil producer ETF and then a ETF that can get you exposure directly to the price of crude. So let's get started. So the first ETF we're going to go over is the iShares TSX Capped Energy Index ETF. It trades under the ticker XEG. And this is one that I personally own myself. In terms of commodity plays, I would rather just, buy the entire oil industry, at least the major players in the oil industry. And this is why I chose XEG. So it's pretty easy. It's one-click diversification to the Canadian oil and gas sector. The goal of this commodity ETF is to provide long-term capital growth. It replicates the TSX Capped Energy Index. So ultimately, this is an index fund. So the ETF's top holdings contain, some of the largest oil and gas and natural gas producers on the planet, including, one of my favorites, Canadian Natural Resources. We have Suncor Energy, we have Tourmaline Oil, we have Imperial Oil, Cenovus Energy, Birchcliff. But the one important thing to keep in mind is this fund does have concentration risk because nearly 50% of its funds are allocated to Canadian Natural Resources and Suncor Energy. I don't necessarily view this as a bad thing because they are two outstanding producers, but it's something to consider. I mean, back in 2020, we saw Suncor cut the dividend and that caused it to underperform for a long time. And as a result, this dragged XEG down with it. So the fund is one of the largest in this video with assets under management of $1.66 billion, and it currently yields in the mid 1% range. However, with the pace of cash flow we're seeing from these oil and gas producers, I would figure this distribution is going to be much higher moving forward. And in terms of management fees, it's a little high for an actively managed index fund at 0.61. But most of these commodity ETFs provide exposure to a particular niche, and as a result, they're going to charge more. When we looked at performance, it's been pretty lackluster. Obviously, it has 10-year annualized losses of 0.93%. However, commodity ETFs are, in a way, a different beast. Returns must be narrowed down to bull-bear environments, specifically to see how a fund is performing. And when we look to, 3-year returns of, just over 14% annually, it looks much brighter. So, as a producer ETF, in terms of oil and gas, this is a pretty good one that you're going to want to have a peek at. You can expect this one to follow the ebbs and flows of crude oil with a little more volatility because it holds the producers. And if we're looking for a just quick, exposure to the price of WTI crude, you should look at the Horizons Crude Oil ETF. It trades under the ticker HUC. Now, this is not a producer ETF. It is essentially an oil futures contract ETF, and it is fully hedged. As you can see by the chart here, it has tracked the price of WTI crude pretty accurately over the long term. So just a quick note, like if you're looking for direct exposure to oil, you don't want exposure via the producers, HUC I think is a pretty solid option. It does have management fees of 0.75, which means you'll pay about $750 per $1,000 to invest. So obviously, you know, what to expect of this one, it's gonna follow the price of oil. This is definitely not a long-term hold. This is something you're likely going to have to trade in and out of with the ebbs and flows of crude oil. So next up, we are going to go over how you can gain exposure to gold through an ETF. And the first one is much like the oil option, it's a producer ETF. It's the iShares TSX Global Gold Index ETF. It trades under the ticker XGD on the TSX. So this fund has over 50 holdings and contains some of the largest gold producers in the world, like Newmont Corporation, Barrick Gold, Franco-Nevada, Agnico Eagle Mines, Kinross Gold, and Yamana Gold. And one thing to note, actually, recently, at least at the time of filming this video, Kinross actually shut down one of its most profitable mines in Russia because of the entire situation. Now, obviously, this is why, for one, especially over at Stocktrades Premium, we always suggest that members are buying material companies with a lot of exposure in non-volatile regions. Think, you know, Canada, the United States, Australia. But this also kind of reaffirms that many people might want to look at the ETF option, because if you own Kinross Gold, you're currently sitting on a situation where it could materially impact the company. Whereas if you were to just buy the ETF, you know, it's a strong holding in it, but it's not the be all end all. So in terms of assets under management, this one comes in pretty big as well at 1.147 billion, and it has a distribution in the 1.5% range. So it's a little higher than the oil and gas ETF. And with an expense ratio of 0.61, you'll pay about $6.10 per thousand invested. So this fund is heavily invested in its top 5 holdings. They make over 55% of the fund. And at the time of filming this, Newmont Gold is by far the largest with over 20% exposure. This isn't necessarily a bad thing, as Newmont Gold is one of the best in-class gold producers, you know, on the planet, but it is something to note. In terms of performance, it's much the same as XEG. Long-term numbers don't really, mean much in cyclical industries. Prime example, this ETF lost 47% in 2013 during the previous gold bear market, but gained over 62% through 2019 and 2020 as gold prices began to rise. You really need to own these and enter and exit depending on the ebbs and flows of the commodity. So again, who this is for. They want exposure to companies that mine gold and not directly to gold itself. This ETF will likely outperform during rising gold prices and underperform during falling prices. This is because the producers tend to be more volatile than the underlying commodity. And if you're looking for direct exposure to gold, CGL and CGL.C are excellent options. So first things, the difference between these two is that CGL.C is not hedged while CGL is. If you'd like to know the difference between these two, I'll drop an article from our website that explains, how hedged and unhedged ETFs interact, how they've performed, what the best options are moving forward. But this CGL, the iShares Gold Bullion ETF, is a very, very simple product. It contains no producers. Its main objective is to replicate the price movements in gold. So the fund has just under $1 billion in assets under management, and at the time has about 0.55% fees, meaning around $5.50 per thousand invested. There's really not much else to say about this ETF. With the currency fluctuations over the last decade, the unhedged has outperformed the hedged by quite a wide margin. But if you want direct exposure to gold, this is a very strong option. So moving on to the next commodity, and that is silver. And silver is when it gets a bit tricky for those looking for a producer ETF here in Canada. There is some in the States. The one we're going to go over is going to be from the States. There simply isn't enough producers here in Canada to build up an ETF that would, garner any large interest. But we can look south of the border at the Global X Silver Miners ETF, and it trades under the ticker SIL. This obviously is a US traded ETF, but the one good thing is, it is still loaded with Canadian silver producers, such as Wheaton Precious Metals, Pan American Silver, SSR Mining. They're all within the top 5 holdings, and Wheaton actually makes up over 25% of this ETF. So the fund aims to replicate the performance of the Selective Global Silver Miners Index, and it has assets under management of just under $1 billion at the time of filming this. The fund contains over 44 silver producers, but it's heavily concentrated, as mentioned, in Wheaton Precious Metals, Polymetal International, and Pan American Silver Corp, which make up over 45% of the fund. In terms of fees, you'll pay around 0.65%, making this one of the more expensive in this video, especially for the passive index fund nature of it. And in terms of performance, again, it's much like the many other commodity ETFs. This will boom when the price of silver it rises, but over the long term, it has lost around 7% annualized over a decade-long time frame. You have to hold these ETFs, buy and sell these ETFs based on the ebbs and flows of the underlying commodity, or you will probably underperform in the long term. So it does have one of the higher dividends on this list in the high 1% range, but it's important to note if you're Canadian, this holds underlying international companies and there might be tax implications, something you need to look at. So pretty much this is for those who don't want direct exposure to silver itself, but instead the companies that mine and explore for silver. And if you're looking for direct exposure to silver, one of the best ETFs you can own is the Sprott Physical Silver Trust ETF. It trades under the ticker PSLV. So you would be hard pressed to find a better option than Sprott's Physical Silver Trust. One interesting thing about this trust is the fact that it does actually hold the silver, so you can actually redeem your units for silver. Now, there are some conditions that need to be met in this regard, such as holding a minimum amount of units. So make sure to have a read of the prospectus and the fact sheet to see if you would actually qualify. So Sprott Silver is held in custody with the Royal Canadian Mint, and it is one of the largest commodity ETFs in this video with AUM of more than $3.4 billion. So the fund does not invest in any certificates or any other instruments that require delivery of silver. This simply holds silver itself. There is no distribution on the fund, obviously, as there are no underlying companies to pay one out. This is a pure play on the movement of silver. Fees will come in at around $6.20 per thousand invested. And in terms of performance, I really wouldn't put much weight into it. You're pretty much buying this on the potential future movement in silver, so past results are completely irrelevant. So next up is uranium. A ton of people want exposure to uranium because they believe it is going to play a pivotal part in the shifting to EV. And much like silver, there just isn't enough producers here in Canada to warrant a Canadian-based ETF. So if we want exposure to uranium producers, we head down south and look at the Global X Uranium ETF. It trades under the ticker URA. However, much like the silver ETF, just because this is a US-listed ETF doesn't mean it doesn't have exposure to solid Canadian companies. In fact, Cameco, a Canadian uranium producer, is the largest holding inside of this fund at allocations in excess of 23%. Other notable Canadian companies are NextGen Energy, Denison Mines, Energy Fuels, and Global Atomic Corporation. But most all of these companies will have mid to low single-digit weightings inside of the fund. So obviously, with the recent surge in popularity of uranium, at least at the time of filming this, volume has spiked in this commodity ETF, and it now trades in excess of 2.2 million shares per day. It costs just shy of $7 per thousand in fees, and it has a net asset value of just over $20.50 at the time of this video. Now, keep in mind, the majority of this fund, around 80%, is invested in American and global depository receipts. So that means some of these shares are held in trust. One word of caution with this ETF, as of right now, the trailing yield is in excess of 6%. However, this was primarily due to a special distribution at the end of 2021. So this fund's distributions are very sporadic, and it won't be an ETF that provides any sort of consistent passive income stream, but it still can pay out some hefty distributions, so that is one thing to consider. Now, if you're looking strictly for exposure to uranium itself, we can go back to Sprott and go to the Sprott Physical Uranium Trust, which trades under the ticker U. So this fund's main objective is to provide a more secure investment for those who are looking to hold uranium directly rather than expose themselves to the operating results of uranium producers. So this is one of the world's first ever uranium trusts. It hasn't been around very long, July 2021. And with the interest in uranium soaring, the fund already has, just under $2 billion in assets under management. And in terms of fees, it's actually the lowest in this video. It only costs $3.50 per thousand on an annual basis. So the fund currently holds, over 44 million pounds of uranium, and trading volume is still relatively low at 17,000 shares a day at the time of filming, but this should not be an issue for most retail investors. So last but certainly not least, this is an industry that has absolutely exploded recently because of these sanctions on Russia. Russia is one of the largest producers of wheat, of corn, of potash in the world, producer and exporter. And as such, the sanctions placed on the company are likely to place a significant production increase and significant demand from the global agricultural industry outside of that country. So I did some digging, and in terms of Canadian ETFs, the only one that I could find really is the iShares Global Agricultural Index ETF, and this trades under the ticker COW. So although this ETF is Canadian, there contains next to no exposure to Canadian agriculture. In fact, even though it's called a global ETF, it has around 93% exposure to the United States and only around 3% to Canada. So this is pretty much a pure play on the US agricultural sector. So this ETF is an index fund. It tracks a Manulife Asset Management Global Agricultural Index, and its largest holding is Archer Daniel Midland, which is a $45 billion plus enterprise that provides things like oilseeds, corn, wheat, and other agricultural commodities. The ticker is COW. It's important not to mix this ETF up with the iPath Livestock ETF. Make sure you search for cow.to. So with 10-year annualized returns of almost 13%, the fund's performance has been actually outstanding. But despite all that, it's not that popular. It has a net asset value of around $71, and this is leaped in the last few weeks because of the situation, and its assets under management sit at around $375 million. Now the volume is quite low on this ETF, but it's not necessarily a huge liquidity risk. It has plenty of volume for the average retail investor, and it's a great way to gain exposure to the entire sector. I mean, this contains companies like Archer Daniel Midland, who produce wheat, corn, things like that. It contains exposure to companies like Mosaic, which is a potash producer, John Deere, the tractor supply company, Tyson Foods, which makes frozen foods, Nutrien, which is a potash producer here in Canada. It's actually one of the only Canadian companies besides Ag Growth International in this portfolio. But it's just, a wide variety of companies that are set to benefit from a rise in popularity in the U.S. agricultural sector. Now, in terms of futures ETFs, if you want direct exposure to something like wheat or something like corn, they do trade, there's a wheat ETF that trades under the ticker WEAT. This is a futures ETF. It tracks the price of wheat. And in terms of corn, it's pretty simple as well. The ticker is CORN. These are futures ETFs. These are likely going to be much, much more volatile than something like the iShares Global Ag Index, but it depends on the exposure you want. And these are, three options that can give you pretty solid exposure to the agricultural industry, with the futures ETFs being more direct commodity based. So everybody, that's pretty much it for the video. Really hope you liked it. I hope this covered a bunch of ETFs that you might be curious about, including some producer ETFs, some futures ETFs, and even some ETFs that actually store the physical commodity. I think it's pretty important, especially in this environment, that everybody has some sort of a commodity hedge. I mean, inflation is just too high right now. There's too much going on in the world, and in terms of protection for your portfolio, if you're overweight something like tech and not enough commodity exposure, you might end up realistically underperforming moving forward. I mean, that remains to be seen. Anything can change. But overall, I really think it doesn't really hurt that much to have some sort of exposure. I own Agnico Eagle Mines, my material play, and I own XEG, the Canadian oil and gas producer ETF here in Canada. Those are both my hedges, and I'm glad to hold them over the next 2-3 years, as I expect commodity prices will be relatively high. But all that said, again, smash the like button, head down below, subscribe, and make sure you comment. You'll be eligible for the giveaway, and head down into the description and hop on the Discord and shoot us a message. And we'll see you next time.